Welcome to Talk Tickers. Today we're ignoring the noise. We aren't looking at the price of the latest dog-themed coin or, the daily volatility of the NASDAQ.
No.
We're looking at the plumbing, the actual plumbing of the global economy.
Right.
We're discussing a structural shift that is, I would argue, more significant than any quarterly earnings report we've covered this year. We are diving into the unified ledger.
It is a massive topic, and frankly, it's one that often gets buried because it's not as flashy as a meme coin rallying 10,000%.
Not at all.
But if you're an investor looking at where the actual value in financial settlement and liquidity, where that's all migrating, this is the end game. This isn't crypto in the way most people think of it. It's more like the banking sector's technological counter-revolution.
Counter-revolution.
Yeah.
That is a strong phrase. It feels like we're watching the transition from, the Wild West phase of digital assets to the industrialization phase.
That's a great way to put it.
So before we get into the weeds, let's give our listeners the 30-second executive summary. What is the headline here?
The headline is that the global financial system is moving from all these disparate, siloed databases to a single, shared, programmable infrastructure, the unified ledger. It's a platform that brings together tokenized central bank money, commercial bank deposits, and assets.
Like bonds or real estate.
Exactly. Bonds, real estate, all of it into one environment. It promises to make settlement instant, risk-free, and programmable. It is the death of T+2 settlement.
And the birth of the intraday economy.
That's it.
Okay, that is a massive claim. The death of settlement lag.
Yeah.
So the mission for this deep dive is to unpack exactly how that works, why it's happening now in 2026, and what it means for institutional investors. Let's start with the basics. You said siloed databases. Paint me a picture of the current system. Why is it so broken?
Well, broken might be a bit harsh, but inefficient is definitely accurate. Right now, the financial world is just a series of walled gardens. Your bank has a ledger.
Yep.
My bank has a different ledger. The central bank has its master ledger. The stock exchange has another one for assets. None of these ledgers talk to each other directly.
So if I want to send you money or buy a stock from you, it's not just one single action.
Exactly. It's a messaging cascade.
Yep.
My bank sends a message, usually through Swift, saying, hey, I'm going to pay you. Your bank gets that message.
Yeah.
Then we have to wait for the central bank to actually move the reserves to settle the debt.
And then the asset has to move.
Then the asset registry has to update ownership. It's this sequential game of telephone.
And that takes time?
It takes time, it costs money and fees, and most importantly, it creates risk. We call it Herstat risk or settlement risk.
Right.
It's the danger that I pay you the cash, but the asset doesn't arrive, or vice versa, because the systems just aren't synced. You're left exposed during that gap.
And the unified ledger solves this by putting everyone in the same digital room.
Essentially, yes. Instead of sending messages between spreadsheets, we're all interacting on the same programmable platform. But it's not just about sharing data. It's about the type of assets on that platform. This is where the unified part comes in.
Okay.
It combines three distinct things. First, tokenized central bank reserves. This is the heavy-duty wholesale money that banks use. Second, tokenized commercial bank money. So a digital version of the deposits you and I hold. And third, the assets themselves.
So the cash and the bond I want to buy are living on the same infrastructure.
Correct. And because they're on the same infrastructure, we unlock the holy grail of financial engineering, atomic settlement.
I love that term. It sounds like something from a sci-fi movie, but it's a computer science concept.
Right. Atomic just means indivisible. In a unified ledger, the exchange of money for an asset happens as a single simultaneous operation. The transfer of the cash is the transfer of the asset. One cannot happen without the other.
So it's binary. Either the whole trade happens instantly or none of it happens. There's no limbo state where I've lost my cash but haven't received my stock.
Precisely. It turns T+2 settlement into T0, instant finality. And when you remove that delay, you free up massive amounts of capital that's just sitting around waiting for trades to settle. We're talking trillions of dollars in liquidity that gets unlocked.
That explains the why. But let's talk about the who. Because for a long time, blockchain was synonymous with startups in garages, right?
Yeah.
Or decentralized collectives. This feels very different. Who is actually building this?
This is definitely not a garage operation. If you look at the landscape today, in 2026, we have moved firmly from the blueprint stage to the building phase. And the most prominent example is Project Agora.
Agora. That's Greek for marketplace, isn't it?
It is. And it's fitting. Project Agora is a massive collaboration. I mean, we're talking about 7 major central banks: the New York Fed, the Bank of Japan, the Euro system, the Bank of England.
Wow.
And they are working alongside over 40 private financial institutions.
That's a heavy hitter list. When the New York Fed and the Bank of Japan are at the same table building infrastructure, it signals that, the adults are in the room.
They're actively prototyping this to solve one of the biggest pain points in finance: cross-border payments. Right now, sending money internationally means passing through multiple correspondent banks. Each one takes a cut, adds a delay. Agora aims to use a multi-currency unified ledger to make that settlement instant.
So it basically removes the friction of borders from a financial perspective. But I want to take a step back here. To understand why we are landing on this solution, a unified ledger run by banks, we need to look at the alternative. We just spent a decade watching the rise of crypto and stablecoins. Why wasn't that the answer?
The crypto detour. And it's important to give credit where it's due. The crypto ecosystem, and especially stablecoins like USDT and USDC, they emerged because there was a vacuum. The traditional banking system was slow. It was only open during business hours. It was expensive. The market demanded speed, 247 access, and programmability. Since the banks couldn't provide it, the crypto sector did.
They built a parallel rail.
They did, but that created a problem that central bankers just couldn't ignore. It looks a lot like the 19th century U.S. economy. We call it wildcat banking.
I remember reading about this, the free banking era.
Exactly. Back in the mid-1800s, private banks in the U.S. issued their own banknotes. A dollar note from a bank in Tennessee might trade for, say, 90 cents in New York.
Because you weren't sure if the Tennessee bank was solvent.
Right. There was no central guarantee. A dollar wasn't always a dollar.
And we see echoes of that today with stablecoins. In times of stress, they can depeg. They can trade for 99 cents or 95 cents.
And that violates a bedrock principle of modern central banking: the singleness of money. In a stable economy, a dollar must be a dollar, no matter who issued it. It has to be exchangeable at par, no questions asked.
When you pay for coffee, the barista doesn't check which bank issued your debit card to see if that dollar is worth 98 cents today.
Exactly, because the commercial bank money we use is backstopped by the central bank. But stablecoins, they're liabilities of private issuers. They don't have that direct access. So when they depeg, they fracture the uniformity of the currency. And regulators realized they couldn't let that become the standard.
Which brings us to the regulatory hammer that dropped recently. The landscape has shifted dramatically in the last year or so.
It really has. By mid-2025, the legislative picture became very clear, especially in the U.S. We saw the passage of the Genius Act.
The Genius Act, what did that actually do?
It established a federal framework for stablecoins. It legalized them, but with a huge catch. It prohibited stablecoins from paying interest to holders.
Ooh, that feels very strategic. So if I hold a digital dollar, I don't get any yield. The issuer gets the yield.
Precisely. It preserves what's called seigniorage, the profit from issuing money for the issuers. But the other major piece was in the FY 2026 defense bill. It effectively blocked the Federal Reserve from issuing a retail CBDC.
So no Fed coin for the average American. That was a huge political hot potato, right? Privacy, government overreach.
It was. No direct bank account with the Fed for you or me. The U.S. explicitly chose a different path. The approach is to support private sector innovation like stablecoins and tokenized deposits, but back them with a wholesale central bank infrastructure.
So the strategy is let the private sector handle the customer interface, the apps, the wallets, while the central bank handles the deep settlement layer in the background.
That's a perfect analogy. The government builds the highway, the private sector builds the cars. This preserves the two-tier monetary system we have today. DeFi wanted to disintermediate banks, right? Get rid of the middleman.
Yeah.
The unified ledger doubles down on the middleman, but just gives them way better tools.
Okay, let's dig into those tools. You mentioned earlier that the assets on this ledger are tokenized. But looking at the technical notes here, a token isn't just a digital certificate. It has layers.
It does. This is where it gets really interesting. When we talk about tokenization here, we're talking about a dual layer structure. You have the core layer, which holds the basic data. Who owns this bond? What's its CU-SIP number? What's its face value?
Just the basic facts of the asset.
Right. But wrapped around that is the service layer. And this is where the logic lives. The smart contracts.
So the rules of the road are baked into the asset itself.
Exactly. The service layer dictates compliance. For example, it can automatically handle tax withholding. If a bond pays a coupon, the token itself can calculate the tax owed based on the holder's jurisdiction and divert that portion to the tax authority instantly.
That is wild. The asset is its own accountant.
And its own compliance officer. The service layer can ensure a bond can only be transferred to a wallet that's passed KYC checks. It embeds the regulation into the asset. So you physically cannot send a restricted security to a retail investor where it's illegal. The ledger just won't process it.
That's incredible efficiency for compliance departments. No more checking paperwork after the fact. The trade is the compliance check.
Precisely. And this is driving some very specific use cases. We mentioned Project Agora, but there's others. Project Pine is a fascinating one.
Project Pine, that was focused on monetary policy, wasn't it?
It was. It showed how central banks could automate reserve management. But the killer app there was collateral. Imagine a world where the Fed can issue tokenized reserves. If a bank needs liquidity, the system can instantly swap tokenized collateral like treasuries for tokenized cash.
And this brings us back to that intraday economy idea you mentioned at the start.
It creates a true intraday repo market. Currently, repo is largely an overnight or term market. But with the unified ledger, a bank could swap treasuries for cash for just 3 hours to meet some specific need, and then swap right back.
Minute by minute balance sheet optimization.
Exactly. It squeezes a tremendous amount of efficiency out of capital that is currently just frozen for the day. It increases the velocity of money inside the banking system.
I see another project in the notes here, Project Premisa. That sounds a bit more obscure, but I have a feeling it's important.
It is, but it's tackling a huge, unsexy problem. Project Premisa is focused on promissory notes. These are paper-heavy instruments used in development bank funding. Think World Bank type stuff.
So they're literally paper documents that have to be physically moved in 2026.
In that sector, yes. We're still moving paper around. Premisa is tokenizing them to clean up that administrative nightmare. It's a perfect example of using this tech not for speculation, but for boring back-office efficiency, which is where the real money is often made.
Speaking of real money and treasuries, we're seeing a lot of movement from the big asset managers. BlackRock, Franklin Templeton, they're all getting into tokenized treasuries.
This is one of the fastest growing sectors. You have funds like BlackRock's BUIDO that allow investors to hold tokenized shares of treasury portfolios. It's putting risk-free assets on-chain, connecting the old world of yield to the new world of blockchain rails.
But this is where it gets complicated.
Yeah.
Because stablecoins also hold massive amounts of treasuries, right?
Huge amounts, over $120 billion in short-dated treasuries. They've essentially become massive, unregulated money market funds, and that creates a huge run risk.
If everyone dumps their stablecoins, the issuer has to sell those treasuries.
Right. If everyone tries to redeem their USDT, Tether has to sell treasuries to pay them. That links the stability of the crypto market directly to the liquidity of the US Treasury market. A stablecoin collapse could cause a hiccup in the world's most important bond market.
Which is exactly why regulators want to move this activity onto a unified ledger where they can see it and control it. But there's a tension here. The crypto natives, the people who built Ethereum, they value decentralization. Banks want control and privacy. How do you reconcile that?
This is the ideological divide, and institutions like JP Morgan have made their stance very clear. They prefer permissioned ledgers over public permissionless blockchains.
Because of the who do I sue factor.
The catchphrase, but it's a serious legal reality. In institutional finance, you need accountability. If a transaction goes wrong on a public chain, a hack, a mistake, there's often no recourse. You can't reverse it.
And banks can't operate like that. If there's a fat finger error, they need a way to unwind the trade.
Of course. On a permission ledger, there's a governance structure, there's identity verification, you know who the players are, but even more important than recourse is privacy.
If I'm a hedge fund, I don't want my competitors seeing my trades on a public block explorer.
It's the deal breaker. Banks cannot put proprietary client data on a public blockchain. This is where the unified ledger architecture gets clever. It uses what's called data partitioning.
How does that work?
Think of it like a partitioned hard drive. Bank A and Bank B can interact on the same ledger to settle a trade, but Bank A cannot see Bank B's other data. They maintain their privacy while sharing the settlement rail.
And the notes mention federated learning here, too.
Yes, for compliance. Federated learning allows institutions to train fraud detection models, for instance, without actually sharing the raw data. The algorithm travels to the data, learns from it, and comes back with insights, but the private data never leaves the bank's vault.
So it offers the benefits of a shared ledger, the speed, the single source of truth without the radical transparency of a public chain. It's a walled garden, but a very, very efficient one.
Correct. And that brings us to the macro implication for the dollar itself.
Let's pivot to that. A few years ago, there was all this talk about Bitcoin replacing the dollar. This sounds more like the dollar is absorbing the technology of Bitcoin.
That is the perfect way to put it. The future here isn't about replacing national currencies. It's about making national currencies programmable. If the dollar becomes the native currency of these unified ledgers, it actually strengthens the dollar's dominance.
It updates the operating system of the dollar for the 21st century.
Exactly.
So looking forward, it seems we are moving toward a world of coexistence. We aren't banning crypto, but we are sort of bifurcating the market.
We are. We'll likely see a tiered system. Regulated private stablecoins, the ones compliant with the Genius Act, will serve retail users and certain fintech niches. They're the cash of the digital world.
But the heavy lifting happens elsewhere.
Exactly. The trillions of dollars in wholesale payments, security settlement, the repo markets, that is all migrating to the unified ledger.
So retail gets stablecoins, institutions get the unified ledger, and the bridge is regulation. The days of Wild West crypto are ending. The banking system is absorbing the tech.
It's a classic integration phase. The disruptive technology becomes part of the establishment's toolkit.
This raises a massive question for anyone deploying capital in this space. If you're looking at a tokenized asset project, how do you evaluate it in this new regime? You can't just look at the yield anymore.
No, you have to look deeper. It all comes down to one specific technical reality: settlement finality.
Which leads us to our signature segment, the one question.
Right.
For every investor looking at digital assets today, what is the one question they need to ask to cut through the noise?
The question is, does the tokenized asset rely on a public, permissionless chain with probabilistic settlement, or does it reside on a unified permission ledger with central bank finality?
Let's break that down one last time. Why does that specific distinction matter so much?
Because for institutional investors, the distance isn't just technology, it's credit risk. On a public chain, settlement is probabilistic. You're waiting for enough confirmations, enough blocks to be added to the chain to be statistically sure the money is yours.
It's 99.99% sure, but never 100% instant.
Correct. But on a unified ledger with central bank backing, you have deterministic finality. When the ledger updates, the money is central bank money. It is risk-free.
That is the difference between a trade that might settle and a trade that has settled.
Exactly. It's the difference between bearing the credit risk of a private issuer, like a stablecoin company that could go bust, versus holding a risk-free settlement asset backed by the state. When the crisis hits, and there's always another crisis, liquidity flees to safety. You want to be on the ledger that has the Fed at the bottom of the stack.
We've covered a lot of ground today. From the concept of the unified ledger to the legislative shifts and these massive projects like Agora, it's clear that while the hype might be in retail tokens, the real revolution is happening in the bank vaults.
And it's happening faster than people realize. This integration of tokenized deposits, wholesale CBDCs, and tokenized assets is going to rewrite the operating manual for global finance. It's efficient, it's programmable, and I think it's inevitable.
I want to leave our listeners with one final thought to chew on. We talked about programmable money, automating things like tax and compliance. And that sounds great for efficiency, but if money becomes smart, does it also become restrictive?
That is the philosophical trade-off, isn't it?
Yeah. If the ledger knows exactly who you are and how a dollar can be spent, what happens to the fungibility of cash?
You gain massive efficiency and safety, you eliminate settlement risk, but you lose the anonymity of physical cash and potentially some degree of financial freedom. It creates a system where every transaction is theoretically visible to a regulator. It's a panopticon of money.
A trade-off the system seems willing to make, but one we should all be aware of as these pilots go live.
That's it for this deep dive into the unified ledger. Thanks for listening to Talk Tickers. We'll catch you on the next one.